The most anticipated IPO in a decade just lost 17% of its value in 5 trading days. Not a meme stock, not a SPAC. SpaceX, the company that owns 60% of global commercial launch market share and operates the only Western crew vehicle currently certified for ISS missions. So the question isn't whether something went wrong. The question is what the market is actually measuring when it prices a company like this down 17% the moment it becomes publicly available, and whether that signal tells us something broader about where we are in the cycle right now. Let's start with the mechanism, not the narrative. When you hear analysts say a stock dropped because of rate sensitivity, that phrase does a lot of work without explaining anything. Here is what it actually means for a company like SpaceX. SpaceX's valuation going into its IPO was anchored around a revenue multiple. The market was pricing future cash flows that are, by the nature of the business, 5 to 10 years out. Starship commercial deployment, point-to-point cargo, deep space contracts, these are not 2026 revenue streams in any meaningful scale. They are 2030 to 2035 stories. And the mathematical problem is this. When the 10-year Treasury yield is sitting above 4.5%, as it has been for most of 2026, the discount rate you apply to those future cash flows rises. $1 of SpaceX profit in 2033 is worth materially less today than it was when rates were near zero. That's not sentiment. That's arithmetic. The compression we saw in that first week is consistent with what quantitative analysts call multiple mean reversion for long-duration assets. In plain terms, the market assigned SpaceX a price-to-sales multiple at IPO that assumed a rate environment closer to 2021 than to today's reality. When institutional desks ran their own discounted cash flow models against actual current yields, the gap closed fast, and it closed publicly. The actionable insight here is not SpaceX specific. Any company you are evaluating where the core value proposition lives more than 7 years in the future carries this same structural risk in the current rate environment. Build the discount rate into your model before you build the growth story. SpaceX did not drop 17% in a vacuum. To understand the move correctly, you need to place it inside what has been happening to Nasdaq valuations across the first half of 2026. A quiet but persistent compression in premium multiples that the financial press has largely underreported because individual names still have moments of explosive upside that dominate the headlines. Here's the pattern. Since January 2026, the cohort of Nasdaq-listed companies trading above 15 times forward revenue has underperformed the broader index by a measurable margin. This is not a crash. It is a slow, systematic repricing of what growth is worth when capital has a real cost. The companies getting hit hardest are not the ones with deteriorating fundamentals. Excellent fundamentals. They are getting hit because their valuations were priced for a world where the risk-free rate was functionally zero and capital allocation discipline was optional. SpaceX entered public markets directly into this compression cycle. And unlike a company that has been public for years and can point to a track record of quarterly execution, a newly public company has no institutional muscle memory around its stock. There is no established base of long-term holders who bought at 40 times revenue and are philosophically committed to holding. The first week of any major IPO is dominated by price discovery among participants who have very different time horizons and cost bases. This is not financial advice, but the framework matters. The entry point for a capital-intensive, long-duration growth company is not the IPO price. It is the price the market sets after the initial holders with the shortest time horizons have exited. That process takes weeks to months, not days. What we watched in SpaceX's first week was largely that distribution happening in real time, at scale, publicly. The 17% drop is the market doing its job. The third layer of this analysis is the one most retail investors skip, and it is arguably the most predictive. not just what the price did, but who was driving the volume. In SpaceX's first week, trading volume was heavily front-loaded. The first 2 days accounted for a disproportionate share of total weekly volume, which is consistent with IPO lockup adjacent selling from pre-IPO holders, who received allocations and moved quickly. This is not nefarious. It is rational. Pre-IPO investors in private rounds from several years ago were sitting on substantial gains. When a liquidity event finally arrives after years of waiting, some percentage of those holders take some chips off the table. That selling pressure in week 1 has very little to do with fundamental conviction about the company's long-term trajectory. What matters for thinking about the recovery timeline is what happens after that initial distribution completes. Historically, the IPOs that recover fastest from large first-week drops are those where institutional buyers, the long-duration funds that build 3 to 5 year positions, step in during the distribution window rather than waiting for clear upward momentum. The signal to watch is not the stock price stabilizing. It is the volume profile normalizing. When daily volume drops back to levels consistent with normal institutional accumulation rather than distribution, that is when the price discovery process is closer to complete. For SpaceX specifically, the complicating factor is scale. This is not a $10 billion company finding its footing. The market cap, even after the 17% drop, represents one of the largest single assets in the Nasdaq 100. The universe of buyers with the balance sheet to move that needle is meaningfully smaller than for a mid-cap growth story. That concentration of potential buyers is why recovery timelines for mega-cap IPOs tend to be longer than retail intuition suggests, often measured in quarters, not weeks. Monitor the volume, not the price. So here is where we land. The SpaceX 17% drop is not a verdict on the company. It is a verdict on the price it entered at, meeting a rate environment that reprices long-duration assets without sentiment and without mercy. The open question we raised at the start, what is the market measuring, now has a specific answer. Discount rates, distribution pressure, and the limits of multiple expansion in 2026. The follow-up question, which we will answer in the next video, does Starship commercial deployment actually change that valuation math? And if so, when? Subscribe so you do not miss it.